The next panel is moderated by Michael Stevens, and we have some of our own people on it. So I will turn it over to you, Michael.
All right, welcome to session 2. What's ahead for the US economy? I think we'll be dealing with some similar themes that came up in the last presentation with, as far as I know, less singing, perhaps. And kicking it off will be Lakshman Achuthan, who is co-founder of the Economic Cycle Research Institute. Lakshman is a regular contributor at the Minsky conferences, and today he's going to be entering the fray in the inflation debate with an emphasis on the role of inflation cycles, which he thinks is the missing piece in this debate. Next will be Michalis Nikiforos, who is a research scholar here at the Levy Institute and an associate professor of political economy in the Department of History, Economics, and Society at the University of Geneva. Michalis works on the Levy Institute's strategic analysis series, which are the results of our stock flow macroeconomic model, inspired by the work of the late Win Godley. We now run the model for the United States, for Greece, and for Italy. Italy is the new edition, and we will have new reports coming out shortly after the conference. And today, Michalis is going to be presenting the preliminary results of the Institute's strategic analysis for the US. Finally, we have Frank Veneroso, who is president of Veneroso Associates, which he founded in 1995. Frank is also a regular at the Minsky conferences, and he recently published a pair of pieces with us, a working paper and a one-pager, which you can find on our website, on his firsthand experience with the Souk al-Manak, which was an OTC market in Kuwait that crashed pretty spectacularly in 1982, and an example of what Frank calls a pure price-chasing bubble. So he examines lessons that episode and others like it might have for today's US market. And for anyone who has heard Frank speak at this conference before, you'll know his lesson is something along the lines of, it's not going to end well. I believe Frank's going to deal with other matters today. So we'll go through all 3 presentations and then a Q&A session at the end. For anyone attending this conference, you can submit your questions in the Q&A pop-up window at the bottom of your screen throughout the presentations, and we'll see if we can get through some of them at the end. And with that, Lakshman has the floor.
Hi, good afternoon, everybody. And thank you. It's wonderful to actually be back after this 2-year gap that we've had. And I would like to speak about inflation. I know everybody's been talking about it today, and I'm going to speak about it again. But this time, as we recover from the pandemic-induced recession. And as we've already been discussing today, there's a wide divide between those who have serious concerns about a run-up in inflation and those who are more comfortable about where inflation is headed, including Jay Powell and Janet Yellen, I guess. The Fed's more relaxed attitude is rooted in their new monetary policy framework, which is featuring an outcome-based approach rather than the earlier forecast-based approach. And the evolution of the Fed's reaction function was the focus of my 2019 Minsky presentation titled Probing Powell's Patience. And I just want to say, which slide is everybody seeing now? Are they seeing the title slide or my notes pages? Just trying to make sure that everybody's seeing the right thing. Hello?
I think now we see the presentation before we were seeing the notes.
Oh, perfect. Perfect. Let me just, I'm trying to, if you bear with me, I just want to make sure I am sharing the correct screen. And you see the Fed forgets the fig, makes a virtue of necessity. Thank you for that. So today I want to zero in on what the Fed has forgotten, specifically the future inflation gauge, or the FIG, because I think it can really help us navigate this divide regarding inflation. And to set the table, this has been part of the discussion again this morning, but I think the pictures are helpful. Let's understand why some are worried about inflation getting out of hand. And so here, you should be seeing a slide of the output gap. And we'll go through why it doesn't seem to really predict inflation. Now, part of this concern around the output gap has been voiced by the likes of Larry Summers and Olivier Blanchard, and includes the idea that the output gap between the economy's actual and potential output is going to blow up. And in theory, that could be highly inflationary. The worry is that even though the output gap is still negative through the first quarter of 2021, the government's enormous spending is just going to push actual output way above potential. Okay. And if you look at the chart, you'll see that in 2018-19, when actual output was well above the so-called potential output, inflation actually subsided, right? It actually was easing off here, and of course, there's the problem. And so this may be why Summers recently said, look, economists don't know what drives this stuff. They're not sure. Okay. Anyway, the empirical evidence notwithstanding, many still feel that the sheer scale of government spending is so huge that it's just bound to be inflationary. So let's take a look at the history of budget deficits over the past century now. And here you have the deficit as a percentage of GDP over the past century. It hasn't been this high since at least World War II. And while CPI inflation has rebounded from 0.25% last spring to 2.6% in its latest reading, and that's partly due to base effects, in itself, this is not yet concerning. So the real question again is, where does inflation go from here? So during the Second World War, despite those very large deficits, inflation stayed in check. And that had much to do with wage price controls. But in the 21st century, even as the deficit as a share of GDP has trended up, again, inflation has been trending down for the most part. So conceptually, one could argue that massive deficits need to be inflated away unless real economic growth actually sees a sustained pickup, as it did in the years following World War II. Yet the empirical evidence seen here, especially from the 21st century, does not support this contention, right? So here's the beginning of the century. So the issue of deficits speaks to the size of fiscal stimulus and possible unintended consequences. But how about the unprecedented monetary stimulus that we've seen? So Milton Friedman famously said, inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. Accordingly, this 100-year chart shows money supply as a percentage of GDP. And that percentage is at an all-time high. But again, looking at the empirical relationship, we see that in the 21st century, this percentage has been trending up quite strongly, yet inflation has been trending down for the most part. And Fed Chairman Jay Powell said as much last month, and I quote, "That classic relationship between monetary aggregates and economic growth no longer holds. We've had big growth of monetary aggregates at various times without inflation, so something we have to unlearn, I guess." Now, the other concept that the Fed is trying to unlearn centers around the Nehru and the Phillips curve. Until a couple of years ago, the Fed's primary inflation forecasting framework was based on the concept of Nehru, the non-accelerating inflation rate of unemployment. The theory being that if the unemployment rate falls below the Nehru, inflation would ramp up. Okay. So in 2018, when the jobless rate had fallen below the Nehru, the Fed was raising rates, ostensibly as a preemptive move against inflation. But again, as the chart shows, in mid-2018, inflation actually turned down. So this failure motivated the Fed's adoption, or helped motivate the Fed's adoption of its new monetary framework, culminating in its subsequent declaration that it would let inflation run above target to make up for all the years it had been below target. Henceforth, it would only consider tightening policy after inflation had risen quite noticeably and we'd seen inclusive growth across different demographics. So lacking the tools to predict inflation, it is declaring that inflation is not the more important part of its dual mandate. It intends to focus on achieving full employment, secure in its beliefs that there's been a structural change, as a result of which inflation would stay subdued even beyond full employment, so it can afford to pursue an outcome-based approach. With this reasoning, the Fed doesn't need to forecast inflation, which it doesn't know how to do anyway. That is why I say that the Fed is making a virtue of necessity. So while the problems of the Phillips curve have been front and center in recent years, let's recall what Fed Chairman Alan Greenspan said over a quarter of a century ago. During his congressional testimony, right after the Fed started its 1994-95 rate hike cycle, Greenspan declared that the experience of the past 3 decades has demonstrated what appears to be a trade-off between unemployment and inflation is quite ephemeral and misleading. It's a quarter century ago. And that was not the only informative part of his testimony. In response to a question about our leading inflation indicators, Greenspan replied that he would look at them very closely. Clearly, leading indicators of inflation were on his radar as the Fed was hiking rates. But the received wisdom today seems to be that the Fed made a mistake back then. After all, neither the output gap nor the Nehru was signaling the need for rate hikes. Wall Street was completely blindsided by those rate hikes and saw the worst bond market in history. In fact, the 1994-95 rate hikes followed the cyclical upturn in the FIG, which is a composite index of leading indicators of the inflation cycle. And the 1995-1996 rate cuts also followed the subsequent cyclical downturn in the FIG. What the Fed had achieved through preemptive rate hikes and cuts was that rare soft landing. Now, notably, in January 1996, the American Economic Association gave Geoffrey Moore its highest award. So the importance of leading indicators of inflation cycles was hardly a deep, dark secret. In fact, in his biography of Greenspan, published in the year 2000, Justin Martin noted that the FIG, quote, would prove to be one of Greenspan's favorite indicators, unquote. And the awareness of the importance of leading indicators, leading inflation indicators, extended to other FOMC members. Here's Dallas Fed President Bob McTeer in July of 1996, explaining why he didn't support rate hikes at the time. Like Greenspan, McTeer didn't believe in the Phillips curve, preferring in principle not to tighten policy on the basis of output or jobs growth or the unemployment rate. But more importantly, he had not given up on trying to be preemptive. He wasn't waiting for a rise in actual CPI, the whites of inflation's eyes, to take action. To the contrary, in line with Greenspan, he explicitly wanted to wait for the leading indicators of inflation to turn up. This framework stands in sharp contrast to the current received wisdom. And I think that's because the Fed has forgotten not only the FIG, but also that inflation is cyclical. And let's be clear about what we mean by inflation cycles. The thin line shows actual CPI inflation, and the thicker line segments show upturns and downturns in the inflation cycle, meaning alternating periods of rising and falling inflation, with the latter, falling inflation, shaded in blue. And in fact, there are many more inflation cycles than business cycles. That is evident from this chart showing the same inflation cycles, along with gray bars indicating business cycle recessions. And as you'll see, the vast majority of inflation cycle downturns occur away from recession. They even occur in periods when actual output is above its estimated potential and the economy looks to be beyond full employment based on the narrow, like in the late 1990s. And that's precisely what happened in 2018, when the Fed and the bond market were blindsided by the inflation cycle downturn. And that's right here. So these inflation cycle downturns demonstrate why the Phillips curve has been so misleading and why the Fed was forced to give up on that framework, having apparently forgotten that it had already walked away from it a quarter of a century earlier. So clearly, the empirical evidence against the output gap or Nehru framework should already have been undeniable. But the straw that broke the camel's back was really this 2018 inflation cycle downturn. Remember, in the summer of 2018, we'd just seen a 4% GDP print, and the jobless rate had dropped to a half-century low. So it's no wonder, given all this, that the Fed was so hawkish. And the bond bears were on the prowl. You had 10-year yields rising to 3.25% in November of 2018. And of course, unbeknownst to both the Fed and the markets, the inflation cycle was already in a downturn, and that was knowable in real time. And this is because the FIG, shown by the top red line, had already turned down decisively And CPI inflation, shown by the black line, after peaking in July, was following suit. And to be clear, the FIG is a composite index of leading indicators of the inflation cycle. So I've given you a very different perspective on inflation forecasting than the standard narrative. Inflation is actually cyclical, and the FIG has a very good real-time track record. Now, we touched on Greenspan and Moore in the 90s, and there was a lot of back and forth between the two until Moore passed away in March of 2000. Particularly prescient in the lead up to the Great Recession. By June of 2008, the FIG had dropped to a 4.5-year low. Yet the Fed was actually quite hawkish. So the markets were pricing in more than 100 basis points of rate hikes by year end. So what is the FIG saying today? For quite some time, it's been telling us that inflation is in a cyclical upturn. As this chart shows, the FIG turned up more than a year ago, and inflation has followed suit. The continued cyclical upturn in the FIG tells us that the inflation cycle upturn is not about to end, even after base effects wear off. Now, meanwhile, the Fed, believing that the Phillips curve is very flat, thinks it can run the economy hot for a long time in order to drive a lot of jobs growth, but with inflation still in check. And that's why, in Powell's words, the Fed is not even thinking of tightening. But others are concerned that inflation can quickly get out of hand, as in the 1970s. Of course, the Fed believes that even if that were to happen, it has the tools to bring inflation back down, as late Fed Chairman Paul Volcker had demonstrated. But whether the modern Fed will have Mr. Volcker's intestinal fortitude to drive the economy deliberately into recession in the face of political opposition is another matter. Notably, the FIG signaled the current inflation cycle upturn well before inflation became a serious concern in the markets. This makes sense because the concept of inflation cycles and leading indicators of inflation is relatively unfamiliar nowadays, not only to today's Fed, but also to the current generation of bond market professionals. Over the last 5 years, ECRI has made 3 inflation cycle calls based on the FIG. In late summer 2020, we called the inflation cycle upturn when Treasury yields were still near all-time lows. That's the red up arrow on the right. We've already touched on our 2018 inflation cycle downturn call ahead of the downturn in yields, and that's the red down arrow in the middle. And in the summer of 2016, when yields were around record lows, we made an inflation cycle upturn call based on the FIG. And that's the red arrow, the red up arrow on the left. Regardless of all this evidence, the dominant paradigm about inflation in the academia, within the Fed, and on Wall Street will not change quickly. And that's unfortunate in many respects. But the good news is that the rest of us aren't forced to play along. As this chart shows, monitoring the FIG in order to manage cycle risk can be pretty profitable. Of course, The big question many have today is whether the current rise in inflation is going to be transitory or if we're going to see a much bigger run-up like in the 1970s. But if you know that inflation is cyclical, you actually don't have to buy into either viewpoint. The fig is agnostic and focused like a laser beam on the future direction of the inflation cycle. So if the fig turns down in short order, inflation is likely to do the same some months later, meaning that the rise that we're seeing now would appear to have been transitory, in which case the Fed could be right for the wrong reasons. Alternatively, if the fig keeps increasing for a while, we could see an inflation scare down the road, and 1970 style inflation wouldn't be out of the question. But is the fig robust enough to deal with such an environment? Absolutely, because it was originally designed in response to the experience of the 1970s. So where is the fig likely to go from here? I would like to know that myself, but it is worth recalling the sage counsel of Jeffrey Moore, who designed the original fig. And he said, don't try to predict the predictors. So thank you very much, and I look forward to questions after the other presentations.
Thank you, Lakshman. Michalis, you're up next.
Let me share my screen. Okay, so. Okay, so can you see my presentation? Yes? Yes. Okay, so good evening, everybody. It's really good to be here. I've been in this session with Lakshman and Frank for a few years now, so I missed it last year. So it's good to be here even online, and hopefully we can meet in the near future in person. So today I would like to make a presentation based on this is some preliminary discussion based on work we've been doing with Dimitri Papadimitriou and Gennaro Zeza for the upcoming strategic analysis of the Levy Institute, which is going to be published within the next few weeks. Okay, so everybody, I don't need to speak about COVID because everybody is familiar with this. We know that 2020 was marked by the pandemic shock, and this pandemic shock essentially caused a recession all around the world, with the exception of China. So we see here the growth rates in different countries and areas and groups of economies around the world. One thing that one can say about the US economy is that the US economy did relatively better compared to most other advanced economies. So we can see that the negative growth rate in the US was more or less at the same level with the negative growth rate of the global economy, but the depth of the recession was relatively smaller compared to other advanced economies. And this was due, obviously, to the fiscal stimulus that took place in the US. Okay, so people who have followed this session in the past and have read our reports, in several reports before the pandemic, we had identified 4 main structural problems for the US economy. One was the fiscal conservatism that had prevailed for most of the last 3 decades. If we looked at fiscal expenditure after 2009, there was real government expenditure only reached the level of 2009 in 2019. So it took 10 years, and this was a complete outlier in every US business cycle in the post-war period. Second, the weak net export demand for US products, increasing income inequality, and the associated financial fragility. So I will just go very quickly through this and see what happened in the last year, and then I will talk a little bit about how close we are to capacity, and then some forecasting based on our model. Okay, so obviously fiscal conservatism is not the case anymore, and these are the federal net outlays as a percentage of GDP. So we can see clearly here that 2020 marks a very sharp increase in federal outlays. So as a percentage of GDP, we're now somewhere in between the 10-20% level, which is the average of the last decades, and the 40%, which was the highest level that was reached during World War II. And we get the same picture if we look at the government deficit. These are the three balances for the US economy. So again, we see here that government deficit was around 15% in 2020. Again, it's is in between the levels of the recent decades and the levels that it reached during World War II. And here we can also see that this increase in the government deficit allowed the private sector to increase its net lending. So it's exactly this fiscal expenditure that allowed the household sector to get out of, to move through this recession without increasing its debt to disposable income ratio. So we see here that we see this deleveraging process of the household sector in the US after 2008, and we see that more or less the trend continues within 2020, despite the crisis, which is it's an important feature of what happened last year in the US. Obviously, this is an aggregate picture of the household sector of the US. If we look at the distributional consequences, the story is more complicated. This is a graph that shows what is the change in the employment rates of different worker groups relative to the pre-pandemic level. So the blue bars here show that as we know that low wage workers, the employment of low wage workers was hit harder during the pandemic. So in April 2020, the decrease in low wage employment was much higher than high wage employment or middle wage employment. And also it has recovered much slower. So low wage employment is still very much below its pre-pandemic level. And you can also see this if you look at the distribution of financial accounts of the Fed. You can see that low income households, so the bottom quintile of households in the distribution of financial accounts of the Fed are increase their liabilities very fast during 2020 after many years of deleveraging. So, and this obviously is related to the pandemic and the picture that is depicted here. On the other hand, the situation when it comes to firms is much worse. So we have highlighted in the past this continuous trend of increasing indebtedness of the non-financial corporate sector in the US. We see that during 2020, these liabilities to GDP ratio jumped very fast. Somebody would say, and this is part of the story, that this jump is due to the sharp drop in the GDP, especially in the second quarter of 2020. But if you look at the data, it's not only that, it's also that the non-financial corporations, they also increase very, very fast their level of indebtedness. Actually, in percentage terms, the change in the accumulation of debt, not normalized to GDP, but the change in the level of debt during 2020 is the highest for the period that we have data for. So this is worrisome. When it comes to the stock market, again, we have highlighted that the stock market seems to be overvalued. We have talked about it many times in the past. Despite the recession, the stock market kept going up. So if we look at different measures of stock market valuation, we see that the stock market is more like the stock market valuation is higher today than it was a year or two ago. This is the Shiller adjusted price to earning ratio, much higher than in the peak of 29, only below the peak in the late 90s. If we look at other measures of stock market valuation, we see that it's now even these keep going up, and we are way above the level of the valuation we had in the late 1990s. Finally, the trade balance, again, we have highlighted several times in the past the weak net export demand for US products. So we see here that if we focus on the trade balance of goods and services except petroleum products, we see this negative trend in the period before the pandemic, right? This negative trend was compensated to a certain extent by the improvement in the trade balance of petroleum products after 2020 because of shale gas extraction and so on. Now, during the pandemic, in 2020, we see that this trend accelerates a lot, and we see a very sharp increase in the trade deficit. And actually, the census just released the data for March yesterday, and we see that this trend continues into 2021. And I think it's reasonable to say that this trend will continue in the next few years because of the fiscal stimulus and because the growth rate in the US is expected to be higher than most of its trading partners. So this is a very quick discussion related to these issues that I mentioned at the beginning. Now, the big question, and I think most of the presenters so far have touched upon it, is how close to full employment are we, or how close to full capacity are we, right? Now, the idea behind people's people worrying about inflation is this idea that you have in New Keynesian model that in the medium run, the economy tends to find itself in some sort of supply side equilibrium level or equivalently at the Nairo level. Therefore, if you are at this level and then you stimulate the economy, this economy will, this will lead to inflation, and not only inflation, it will lead to, a vicious cycles of higher expected inflation and higher inflation, and therefore, sooner or later, you end up with a hyperinflation situation. Now, this idea aside of this, how expectations play a role, we can look at what was the situation in 2009, right? Compared to what was the situation in the labor market. And this is the employment to population ratio in 2009. In the first graph here is relative to December 2007, so relative to the peak of the previous cycle. And in the second graph, it's relative to June 2009, meaning relative to the beginning of the recovery in 2009. And the blue, okay, so the blue bars are the numbers for February 2020. The red bars are March 2021. Right? So we see that even in February 2020, even before the pandemic shock, right, the employment to population ratio for workers with a bachelor degree or higher, this is what this means, was below its level of December 2007 and June 2009. For those with a high school degree, it was also lower, the employment population ratio relatively to both June 2009 and December 2007, right? So the only group of workers that saw an increase in their employment population ratio are the workers with unskilled labor with less than a high school degree. right? And this, I mean, obviously you can adjust this for the aging of the population, but the picture does not change, right? So it's not, this is not due to the aging of the population. Meaning what? That if we look at high school graduates and workers with a bachelor's degree or more, the skilled labor, if you want to call it this way, the employment to population ratio was way below before the pandemic, before the recession, than it was 10 years ago. And this doesn't show that we were in full, anywhere close to full employment in 2019 or February 2020 before the recession, right? And obviously, when it comes to unskilled labor, I think it's reasonable to argue that the supply of unskilled labor is way more elastic than the supply of skilled labor. Another measure of how close we are to capacity output is, which usually is not mentioned in these debates, is the capacity utilization measure. So the Federal Reserve publishes a capacity utilization measure. This is the orange line here. So what we see here is that in 2019, this capacity utilization measure was 6.6% below the level of capacity utilization in 1989, which is the first year of the sample, right? So we see that if we focus at the Fed measure, we see this slow downward trend in the rate of capacity utilization. Now, the Fed measure of utilization tends to be stationary. Like there are several technical reasons. There is another measure which is more appropriate to measure long-run variations of capacity utilization, and this is the emergency rate. The emergency rate is published by the census, and it's based on a question to plant managers. Well, if we had an emergency, if we had a war, what would be the total output that you could produce, right? And we see that therefore the capacity output is closer to an engineering measure of output, and it's less controversial related to the measure that is used by the Fed. I can talk about it in more detail in the Q&A. Now, if we focus at the emergency rate, right, we see that again in 2019, this emergency rate is more than 40%. It's 14.2% below its level in 1989, right? So if we take both of these measures into account, meaning the employment population ratio and especially the breakup by educational attainment and the measures of capacity utilization, it's hard to argue that even before the pandemic, we were close to full employment or full capacity. Right? There was still space at that point. Therefore, I think that this idea that we are, inflation is right around the corner, and because we're going to hit some sort of full capacity ceiling, aside from what Robert Barbera said, that if you have a higher growth rate, this will induce higher productivity growth, and therefore this will also move the ceiling. But in the first place, we were much below the ceiling even before the pandemic, and there was even then a lot of space for demand induced policies. Okay, baseline scenario. So we usually, and this is what also we did this year, we build the baseline based on the CBO's projection. So this year's CBO's projections were published in February, and we used our model to examine what are the conditions necessary for these projections to materialize, and we make assumptions that are as neutral as possible. So for example, we use the IMF projections for the growth rate of the US trading partners and the inflation rate in the rest of the world. And this is how we determine the demand for US exports, right? Or we use the Federal Reserve projections for the interest rates as the values for the interest rates that we use in our simulations. Okay, so by the way, the CBO projections were published in February, meaning that these do not include the Biden stimulus. And I will say more about that in a few minutes. So you know, in a nutshell, the CBO projection is that the deficit that reached 15% in 2020 will decrease quickly, so it will go to 10% this year and then even quicker the year after. So essentially it will reach 4.6% and then 3.6% in the year after, in the years after that. And then the growth rate will reach 4.6% this year and then 2.9 this year, and then it will go back towards 2.2, 2.3%, which is some sort of natural growth rate in the CBO model, right? So this is what we get. These are the three balances for the US economy when we simulate the CBO baseline. What we find based on our model is that this is, you know, this is a reasonable baseline scenario. If we take into account that this does not include the Biden stimulus, and if anything, the CBO projections underestimate the potential growth rate for this year. Maybe the growth rate can be even higher than that. Now, however, at the same time, an issue that comes out when we run the simulations is this pressure on the trade deficit that I mentioned before. So we see here how even at this baseline, the current account balance decreases and the current account deficit reaches minus 5% by the end of our simulation period. Michael, I cannot. Okay. I don't want to miss. I don't want to exceed my time limit, so I just need to keep an eye on Michael. Okay, so this is the baseline scenario. Now, as I said, the CBO, the American Rescue Plan Act that was voted in early March was not included in the CBO forecast. This is a summary of this of the Biden stimulus of the American Rescue Plan Act. Again, these are numbers that are estimated by the CBO in a publication that was released after their original publication, right? So if we put these new numbers with the Biden stimulus into our model and we simulate it, what we see is this picture for the three balances. So this is the baseline plus the Biden stimulus. We see here that government deficit obviously does not decrease as in the CBO baseline, but it keeps being close to 14% in 2021, and then decelerates later. It decreases later. At the same time, the foreign balance decreases even more, obviously because the growth rate of the US economy is even higher. This tends to increase the current account deficit more than the baseline. And because by the end of the projection period, the assumption here is that government deficit has converged to its previous level, to the level that we simulate in the baseline, but the current account deficit is higher, we see that the private sector ends into a net borrowing territory for a first time after a long period. And these are the related growth rates. So given the baseline plus the Biden stimulus, our model projects a growth rate above 6%, 6.2% in 2021, more than 3% in 2022, and then the growth rate converges to the CBO baseline's projections. Incidentally, I was checking the recent projections of the Fed, and these are very, very close to the median projections of the Fed. Although I think that, as I said before, there are more chances that we underestimate the growth rate for 2021 than we underestimate it. Okay, so 2 minutes. 2 minutes for the 20 minutes or the 25 minutes? Okay, let me just go quickly to my last slide. So recently, after the original stimulus plan, President Biden announced plans to a 2 trillion plan to rebuild infrastructure and 1.8 trillion family plans that deals with childcare, pre-K, paid family leave, and so on. And he also said that the plans will be paid. I put the paid in quotes, by increases in the taxes of high-income households, right? And again, for people who have followed our policy reports, we have simulated over and over again related scenarios, related in the sense what would be the benefits of a large infrastructure plan. Actually, we have simulations of a $2 trillion infrastructure plan, and scenarios that you will have this kind of fiscal expansion, which will be accompanied by an increase in the taxation of rich households. Right. So in this report, I will show you the result, and we found that this kind of scenarios have positive macroeconomic effect. So I will show you some results of a new replication of a scenario that was simulated a couple of years ago. The idea here is that you increase the tax rate of high-income households at the top 1% by 10 percentage points, right? And at the same time, this increase is accompanied by an equivalent increase in government outlays. We make several adjustments for, this incentive of high-income households to generate income and so on and so forth. So these are conservative estimates in general. So this is scenario one. Again, scenario one is an increase in government outlays by 1.3% of GDP per year, which is accompanied by an equivalent increase in revenues based on taxation of high-income households. Scenario two simulates the same increase in government outlays without the increase in taxation, right? And this scenario, I think, is interesting because it can give a sense on what are the macroeconomic effect of this sort of plans, right? Meaning that if this plan is allocating into a 10-year period or a 7-year period, then the increase in fiscal expenditure is around this level. And what we find here is that in our projection period in the next, the idea here is that these plans are enacted in 2022. We see some significant increases in GDP relatively to the baseline scenario, right? So I think I've exceeded my time. Let me just conclude with this graph that puts some perspective on the current debate. This is these are our simulations, right? So this is the simulation of the baseline scenario and scenario two. Remember, scenario two is the baseline, which includes the Biden stimulus plus this increase of fiscal stimulus by 1.3% of GDP, right? And this is the trend for the period based on the period 2001-2007. So remember that, yes? Okay. Remember that the recovery of 2001-2007 was the slowest recovery in US history until that time, right? So if we extrapolate that trend, you see where we are now. You see where we were before the pandemic. We were 15% this trend. And you see where we will be in 2024, even with the Biden stimulus and even with an infrastructure plan or the sort of fiscal stimulus that is discussed right now, right? So I think this puts some perspective on the discussion beyond the discussion of the employment population ratio and capacity utilization and so on. So I hope I didn't abuse my time too much, and I will be happy to answer any questions later. Thank you.
Thank you, Michalis. Frank, you have the floor.
Okay. Do I show up there? I have no charts. I'm going to just try and tell you a story. It doesn't have to do with trying to project what's going to happen to the economy over the next couple of quarters. I think with the biggest increase in the money supply in our history, 28%, I think with 2 years of a 16% fiscal deficit, percent GDP, the highest in our peacetime, that the surprises over the short run are going to be at the upside. I'm not going to talk about employment because the data is no good. The continuing claims data says that we've lost 15 million jobs, and the BLS data says we've lost 8 million jobs. And the data on anecdotal evidence about the labor market conditions say that it's number of jobs have been lost even much less. There's a lot of fraud in all the data. It's a mess. Okay, so put me in with Larry Summers, except I think he understates it. What I want to tell you about is a Minsky story, because this is a Minsky conference, and I want to tell you about the state of the American economy. It's the same, I think, for the global economy, but we've got to make it simple. Okay, the story is as simple as this. The Federal Reserve has told you that the private non-financial debt to GDP ratio is 147% at the end of 2019. We've done a lot of work on this. We believe that ratio was 240%. We're sure of it. It's an enormous mistake. What that basically means is that our private indebtedness fragility was the highest not only in our history, but as high or higher for any country in the world over 3 centuries. The bottom of the Depression, it was 227. When nominal GDP fell in half, it was 213 in the early 90s in Japan. Now we have to prove that, and we can prove that. We have a book coming out that has a quick summary of our conclusions. We have a paper we took out of that book that gives more detail, and we have a 16-chapter document that goes through the entire research and all the calculations that are made. So we entered the COVID contraction with a record financial fragility on debt account. Okay, on equity account, on the asset side account, which I didn't care about very much. Well, you saw Michalis' chart of the market cap to GDP ratio. All of these PE ratio comparisons that are made in the Fed's financial stability report across Wall Street are all based on comparing apples and oranges, because there's been a tremendous amount of liberalization of accounting standards over the time periods that you're looking at. And we can get around that to some degree with the market cap to GDP ratio. Basically, the eve of COVID, that ratio was back up to where it was at the peak of 2000 and the 2000 dot-com bubble. Okay. So we had this huge contraction in income. We should have had a classic financial crisis, and we didn't. So what happened during this period is all important, and how we've come out of it is all important. Let me consider the debt side of it. We didn't have a financial crisis because we had a lot of transfers to the indebted, but more importantly, we have entered into a state of ubiquitous forbearance. And that actually leads to higher indebtedness, above and beyond what the data shows. Now, Michalis showed you some data, official data. It's very partial. It's nothing like the total picture that we look at, but it showed an increase in the debt to GDP ratio. It showed it accelerated in the COVID period. If you actually take the deferred interest payments, which are part of the Ponzi, that forbearance involves, for which there's no data, it's even worse. So as a result, we are leaving COVID with a financial fragility on debt account that is unlike anything that has happened in any country in three centuries. Okay. Now on equity account, as Michael showed, we have had a new high in the market cap to GDP ratio. It's 200% now on the Wilshire. It was 149 at the peak in 2000. And if you look at what happened in the market, what you see is that there was a fringe that went vertical. 18+% of all the companies sell for more than 10 times sales. The peak of the dot-com, it was 13%. Now, this kind of equity market behavior, these kinds of valuations, this kind of hyperbolic price behavior is rare in history. For it to engulf a stock market, people think there have been a lot of bubbles. There have not been a lot of bubbles. Bubbles are very, very rare. We think that there have only been about 10 really extreme bubbles where valuations got really crazy and prices went truly hyperbolic. We have analyzed all of them, not in just a statistical sense, but in a behavioral sense. And we feel very confident that the current stock market is one of the 9 most extreme, hyperbolic, pure price-chasing stock market bubbles, again, over all countries and 3 centuries. So now we have a dual super extreme financial fragility, something that High could have never even imagined, and which most people don't realize because they don't know the real debt numbers and they look at all the wrong measures of valuation. Okay, but what this kind of means to us is that once we come out of this boom with all this money growth and all this fiscal stimulus, we're going to have a state of the economy, a Minskyan state of the economy, which I can only describe as a sort of unparalleled financial fragility that is kind of an event horizon around a Minskyan black hole. And at some point, such an economy will get too close to that event horizon. We really don't know what that path will be. We are just telling you that we can measure financial fragility, we can compare it to all other instances in global history, in our own history, in global history, and that's basically what it sizes up to be. Okay, so that's a lot of assertions, so I should defend a little bit our assertions. Now, on the indebtedness side, on the debt statistics side, we've made presentations in the past about this. No one ever took us seriously. And since then, we've done a hell of a lot more research. We have a hell of a lot more data. And let me tell you in a nutshell what we found out. We found out that the Fed has made 12 errors of omission. Not 1, not 2, 12. And we've gone out and we have found the data that we needed in order to be able to fill in the blanks. And that's required a certain amount of interpolation and some assumptions, but we think that we're pretty close to what the total really looks like. And when we do all of that, we get a increase in the estimate of non-financial enterprise debt that's about 90% of GDP higher than the Fed's number. About half of that is off balance sheet, which is very, very important and has been growing. And we have a better window on that now that companies, public companies at least, have to report this. And we've been able to make estimates of the rest of the enterprise sector. Now, none of you will believe me, of course, but I will give you a little exercise mathematical exercise that will prove to you that I am right. Okay, so if we take a look at the end 2019 Fed data, enterprise debt, we see that as a share of GDP, it's about the same as it was in 2007, a little higher, but not much higher. Okay, we all know what happened to interest rates. We know that there was a time period long enough that all long-term debt could be refinanced down to very, very low rates. We know that the borrowing costs have fallen in half or by more than in half. Okay, if the debt to GDP ratio was constant from 2007 to the end of 2019, then the interest coverage ratio would have soared. It would have doubled. It would have more than doubled. But we have a lot of interest coverage ratios for different universes. And instead of going up, they went down. For the public company universe, they went down by a lot. For broader universes, they went down by less. Maybe if I had data on a really, really broad universe, it might have gone up by a little bit, but there's only one way you can make this math work. And that is that the debt to GDP ratio has to have doubled, or maybe more than doubled. It's really simple. We have all the numbers. We've identified all the errors. We can bottom up prove this thesis, okay? And we, as I say, have that in three forms. One in a chapter in a book we're trying to push out now, one in a bigger essay, and this 16-chapter statistical mess that will someday get out. Okay, so now we're about the valuation of equities. The Federal Reserve and Wall Street are very fond of taking a look at something called IBES operating earnings, and they come up with 17 times multiple at the end of 2019. And they say, oh, well, that's the way it was, 30 years ago. The fact is, over this 30 years, there's been an incredible change in accounting. If you go back 30 years ago, IBES, non-GAAP operating earnings were the same as GAAP operating earnings and GAAP bottom line earnings, okay? Because of all these accounting liberalizations that have occurred, today there's a differential of about 20 percentage points between the two of them, which is why you have a much higher PE ratio if you go to the GAAP data. But even the GAAP has undergone some of the same creative accounting as has the non-GAAP accounting. Now, there's a way we can come up with a PE ratio. It's an amazing thing, but there's a lot of data to this effect that once you get outside of the biggest several hundred companies in the public universe, there's no more profits. All the profits, aggregate profits, are just in those companies. The rest of the list in aggregate has no profits. 30% to 50% of the companies have GAAP losses, and like I say, on aggregate them all together, they have no profit. So we can simply take the S&P 500 GAAP profits, assume that the rest of the list doesn't have any profits, take the total market cap, and we can come up with a PE ratio. And that, at the end of 2018, was something like 28 times, and today, trailing, it's over 50, and probably on some, I don't know, trend, it normalized. It's probably in the high 30s. So there's a way thereby to support the chart that Michalis showed you. Okay, that's pre-COVID. Now, what happened after COVID? We should have had a financial crisis, but instead we had on the debt side grants, emergency loans, and more importantly, both government mandated and private sector agreed upon debt forbearance. It's a world of Ponzi finance. And we don't know what has happened to the debt to GDP ratio during this period because most of our data is lagged. But if we take the data that's available, we think there was an acceleration in the indebtedness ratio. And I was intrigued by Michalis' chart because that looks even like a steeper increase than the data that we have. But as I said, all the deferred debt service payments involve the capitalization of interest, and that particular addition to the outstanding debt will not appear in any of the data until we get IRS data 3.5 years from now. Okay, so we think that there has been a very, very large increase, we can't quantify it, in the private non-financial debt to GDP ratio, adding significantly to the financial fragility. Now, on the equity valuation side, I think that the increase in the market cap to GDP ratio based on the Wilshire of 149% in 2000 to 200% today probably captures appropriately what has happened. What's interesting though about it are the dynamics, okay? Because the increase, fourfold increase in stock prices that occurred throughout the past decade were driven by what we know, very, very low interest rates and a very high level of corporate purchases. Full of funds data suggests that the corporate purchases were the real only big driving purchase during this period. Our numbers, which we get from private sources, are somewhat higher than the Fed's, and most of it therefore had to be done with debt. And we see in our data that the highest rate of expansion of indebtedness during the decade was in the public sector, public company sector. So all of this fits together very nicely. Now, something changed starting in 2019, but particularly in 2020. We wound up with a new class of players, which was this retail army, this Reddit army that operates through Robinhood and things like that, that loves all of these tech companies that have no sales and have no earnings. And we can see their activity, 10% of retail trading. Retail was 10% of trading in mid-2019, 20% second quarter of last year, 30% by end of summer, higher in the end of the year into this year. And that was a new driver that created these hyperbolic charts of so many of these stocks that has raised the overall valuation to a level that's above 30 times earnings. Okay, so how do we analyze this? What do we think about this? What we've done is that we have identified, well, let me say, defined what we call a pure price chasing bubble. All overshooting in markets is driven by extrapolative expectations. And they can be extrapolative expectations of fundamentals, and they can be extrapolative expectations of price alone. And when the price earnings ratio gets not to 20 or 20, when it gets like 30 and beyond, then most of the market participants really are not extrapolating business fundamentals. And certainly when you get the herding of neophyte investors that are drawn to all this quick money making in the bubble, they surely do not focus on any fundamentals and extrapolate them forward. We call these pure price chasing bubbles, okay? So we're not interested in markets that sell for 21 times earnings. Everyone thinks that 1929 was a bubble. It wasn't a bubble. It peaked at 21 times. We had peaks of 21 times in bull markets, 9 times in 103 years between 1890 and 1993. No, these are something different. These are where the PE ratio goes to 33 times or 50 times or 120 times or close to infinite. So I'll give you the list. The Mississippi bubble, the South Sea bubble, Brazil 1971, Taiwan 1990, Japan 1990, .com in the United States, at least the fringe of NASDAQ and China 207. The Saudi market in the early 2000s is probably another one. We don't know enough about it. And then there's the Souk al-Manakh. You'll laugh at me about bringing this up, but in 1982, 37 companies on an over-the-counter exchange in Kuwait had a market cap that was second only to the United States and Japan and greater than that of London and all of its foreign listings. These were real crazy bubbles, all right? So we got inside of those. Now, I put on the Levy website one of the chapters out of our book, which is an account of the Souk al-Manakh. You can see the type of analysis. In every one of the cases that we've done, we have had people, sources inside to tell us not about statistics, but to tell us about behavior, to tell us about dynamics. They're all sort of like what I put up on the website. Okay, what did we learn from this? We were interested in what were the causes and what were the conditions. And I'm going to read to you what we concluded. There are always foothills of such stock market bubbles. There's always an initial trajectory of extraordinary price appreciation. Sometimes such a period is long and steady, sometimes it's shorter, but to affect behavior, it must be very, very steep. In many cases, there's a prior period of extraordinary economic expansion that gives rise to optimism and eventually euphoria, but not always. Sometimes it is government manipulation that creates the steep price trajectory that spawns manic extrapolative expectations. In most of these cases, there's a distortion to the perception of prospective risk. Some government action or long-standing cultural tradition leads speculators to expect bailouts. Moral hazard rules, stock prices levitate. Sometimes, but not often, there's a very rapid expansion of the money stock. More frequently, one finds an especially rapid expansion of credit. More often than not, there are investment bankers and brokers and some corporations of a speculative bent who act as promoters to the point of engaging in outright manipulation, sometimes manipulation by government entities, companies, or is accompanied by the manipulation of such private parties. Lastly, there needs to be a concentration of many people in close communication. This is a condition necessary for contagion, information cascades, and a gathering and growth of a madding crowd. Okay, from today's perspective.
Frank, you have about 1 minute remaining.
1 minute left?
Yes, sir.
Oh, what can I tell you? If we apply all of these to the United States today, what we find out that it's rather unusual. There isn't the economic boom to create the optimism, but there is the money supply growth this year, and going back further, the fostering of mega moral hazard by the central bank. What we find out is unlike most of the pure price chasing bubbles. We can find the origins here, not in what people normally think cause these things, but the actions of a highly misguided central bank. Okay.
Thank you, Frank. All right, that brings us to Q&A. And to kick it off, I think it's best if we open it up first to see if the panelists have any questions for one another. And if you do, just go ahead and jump in, and then I'll go to the Q&A queue on here.
I cannot turn on my screen. It has been disabled by...
All right. Jake or Liz, can we turn on Michalis' screen? This video, there we are, you're here. Go ahead.
Well, I have a, I think I see a related question in the chat for Lakshman. Like, what are the components of this, of the fig? And if we think that this fig is random and we cannot predict it and so on, should we care about it? Because if we cannot predict it and it just follows a random path unrelated to the policy stance, then whatever policy we follow, then it doesn't have any effect on it. So then we why should we care about it? Inflation will go up and down, but this is completely unrelated to the policy stance.
Well, can you guys hear me okay? Thank you. As to what's inside the FIG first. Let me just answer that directly, and then we'll get into the implications. It includes measures ranging from kind of early stage inputs to labor markets and so on. So it's not like some super secret input. And also, so you guys know, Dr. Moore, this is just a quick story you wouldn't know, but Dr. Moore's summer neighbor in Vermont was Milton Friedman. So you can rest assured there's a lot of inputs related to money and credit. But the key thing is that it is not related to policy. This is a monitoring device. It can predict the cyclical, it aims to predict the cyclical turning points in inflation, which is a piece of useful information. The key thing that the FIG accomplishes is recognizes when the different drivers of inflation cycles begin to reinforce each other. And that's what really the FIG captures. So it very much is related in the end to some of these timing decisions, right? You can have a forecast-based preemptive approach to policy, say from monetary side, or kind of an output-based approach. I'm going to wait until afterwards, after it moves. And if you want to be preemptive, which we can get into why that may be a good idea, then this is a very pragmatic, agnostic tool that actually has a really good real-time track record. And it was something that was used for monetary policy, as I suggested, back in the mid-90s. So if we look at that, it's hard to prove a counterfactual what would have happened in other instances, but that was a long expansion. It did have a lot of kind of positive benefits around it that we can get into. But policy is not the only driver to this. The free market economies, inherent in a free market dominated economy is a cycle. Okay, we've had separate discussions about business cycles. Here we're talking about the distinct inflation cycle. And this is a very, very good monitoring tool. It's not a model.
Right. A related question, what is the typical lag time between FIG and realized inflation?
Right, so again, certainly it's hard to be precise with in economics, but the lead times varies on the FIG. The real-time lead time varies on the FIG a bit from cycle to cycle, but it generally turns a few to several months ahead of actual or realized inflation.
And other questions for each other from the panelists before we go to the queue? No. All right. So Michalis, you had an aside in your presentation in which you talked about the Fed's measure of capacity utilization and the emergency measure of capacity utilization, more of an engineering concept, which I think you mentioned you wanted to come back to. And so as we're looking at issues with supply bottlenecks, whether it's lumber, semiconductors, what have you, maybe you want to come back to that and speak about the relevance of it looking forward.
Right. Okay, in a nutshell, the Fed's, like both measures of utilization, they're based on the survey of plant capacity, which is conducted by the US Census. Like the question is, how do you measure capacity, right? How do you measure capacity output? Because utilization is actual output over capacity output. Now the Fed measure of utilization is based on a measure of output, which is of potential output, that is based on the question, what is the the maximum output under normal conditions, right? Now, this question is ambiguous, meaning that if you are a plant manager and somebody comes and asks you what is your maximum output under normal conditions, then if for a long period of time you run your plant for one shift, then these are your normal conditions. If you run it for 2 shifts, then this is your normal conditions and so on. And that's why because of this ambiguity, the Fed measure tends to be much more stationary. Now, if you look at the emergency rate of utilization, because the question is less ambiguous, meaning how can your plant produce if you had to run it 24/7? The ambiguity of the previous question sort of disappears, and therefore it's a better measure to capture long-run trends of capacity utilization. And as I said, there is a 14% decrease of this measure of utilization over the last 30 years before the pandemic, which is, it's a sign of a very significant slack at least in the manufacturing sector.
Thank you. And we have a question in the queue from Torvald, a colleague of ours, for Frank, which is, how is household debt at a record high when Michalis figures show continuous deleveraging since the global financial crisis?
Okay, household debt is down by 20% of GDP. We don't question the Fed's data on household debt. It's all enterprise debt. And the enterprise debt is just hugely higher. Look, I can give you an example. We asked the Fed statisticians, what are your numbers for private placement debt? Oh, we don't have any data on that. Can you tell us where we can get that data? Well, the SEC produces from private data aggregators data on flows. This is long-term debt. And the flows are $1 trillion a year for just 144A, one class of private placement debt. The data's there. The aggregators don't capture everything, okay? This is a big error. We have found a whole bunch of these errors.
And I think we have time for one more, another question from the queue for Lakshman. Can inflationary pressures persist if nominal wage growth remains weak? Still muted.
Sorry, I was saying yes.
There we are.
This is a short answer. And I was saying, actually, wage growth upturns typically lag at inflation cycle upturns. So while, I mentioned earlier to Michalis that labor market measures are relevant, they're captured, it's not about wage growth directly.
That brings us to 2:30, which is the beginning of the next session. I'd like to thank all our presenters today, Lakshman, Michalis, Frank, and all the questions that were submitted. That brings us to the next one.